Welcome to the deep dive. If you checked your portfolio anytime between October 10th and 11th, 2025, well, you know exactly what we're talking about today. We are wading through the fallout of what was pretty unequivocally the largest crypto liquidation event in history. We've got the full stack of source material you shared with us, the real-time exchange data, the on-chain stuff, analyst reports from everywhere. And our mission today is really to cut through the FUD and the noise. We need to dissect this sequence of failure. What actually triggered this sudden catastrophic market break? Why did the internal market structure amplify the chaos so quickly? And maybe most importantly, what does this shakeout mean for the rest of Q4 and, well, the path forward for 2026? Okay, let's anchor this first. The scale of the shock. This was no small dip, right? We're talking about a $19 billion wipeout in leveraged positions, almost instantaneous. Bitcoin, the big one, plunged over 15% in minutes, fell from what, above $122,000 all the way down below $107,000. Just a vicious reversal. Okay, let's unpack this. Where did that initial seismic shock even come from?
It's fascinating, actually. The fault line wasn't really internal to crypto this time. It seems it was purely geopolitical. The market was already running pretty hot, maybe a bit frothy, so the trigger had to be something external and, well, massive. And it was the immediate spark. President Donald Trump's announcement, sweeping 100% tariffs on Chinese tech imports and goods. That landed like a bomb. And this news, it didn't just rattle the Dow Jones or traditional markets, it basically ignited a massive global risk-off firestorm. We know crypto is a high beta asset, right? It just amplifies the moves of traditional markets, both the good and the bad. So when these global trade war fears spiked, liquidity just vanished. And the pain in crypto was amplified like 3, 4, maybe even 5 times over. You can see almost instantly in the data. Crypto fear and greed index, it flipped dramatically. Went from 64, which is comfortable greed, down to a terrified 27. That signals acute fear, all in just 24 hours.
Wait, hold on. $19 billion wiped out just because of a political announcement. Doesn't that kind of suggest the foundation was already incredibly shaky? I mean, how much of this crash was genuinely geopolitical and how much was just, pure internal market sickness waiting to happen?
That's exactly the critical point. The tariffs, they were the match, absolutely. But the market's internal structure, it was soaked in kerosene. Completely. We were dealing with a massive leverage tsunami, as some analysts called it. Traders had gotten incredibly complacent, just way too much risk built up.
And we know why, don't we? Everyone was riding high, feeling kind of invincible,
Yeah.
fueled by those record-breaking $5.9 billion in ETF inflows we saw just in early October. That much money pouring in creates immense confidence, right? And that confidence translates directly into excessive use of leverage, especially in the perpetual futures markets.
Exactly right. The sources are showing the problem wasn't really the spot market selling initially. It was the cross-margin accounts. When the price started dipping even slightly, those highly leveraged positions, we're talking 50x, sometimes even 100x leverage, they started hitting their margin call thresholds almost immediately. This forced massive non-discretionary selling. People didn't have a choice. The exchanges forced them to sell. And that selling drove prices down further, which then triggered the next wave of forced liquidations across the whole ecosystem. It creates that terrifying, self-fulfilling death spiral we sometimes see.
And wasn't this rapid structural failure also accelerated by some kind of anomalous technical incident too? I remember reading something about a huge trade.
Precisely. We really can't overlook the specific event that seems to have turned a severe correction into an outright flash panic. There was an $88 million Bitcoin trade on a major exchange, a single massive market sell order. And that sale, happening in a moment of really thin liquidity, it momentarily just blew out the price difference, the DPEG between the spot price and the perpetual futures price. That immediate divergence then hit DeFi protocols and other leveraged platforms really hard. Basically, bad Oracle data started feeding into their systems, which led to liquidations happening far faster and frankly deeper than they probably should have, based purely on the spot price movement. It was a technical cascade on top of the leverage cascade.
Okay, so if we zoom out a bit,
Yeah.
It wasn't just tariffs and leverage causing this mess. You mentioned broader economic pressures were already there.
Yeah, connecting this to the bigger picture, absolutely. There were macro headwinds already brewing, definitely. You had rising U.S. Treasury yields, which makes traditional finance look a bit more attractive, relatively speaking. The dollar was strengthening. And persistent global inflation was just squeezing overall liquidity everywhere. Analysts were pretty quick to point out that this combination, this cocktail of excessive leverage and really elevated risk tolerance, was like the underlying rot that just needed a trigger, any trigger really, to expose it.
Hang on, if institutions were apparently accumulating all along, as the Glassnode data seems to show, was it really rot? Or was it maybe just retail froth being washed out? Because the sentiment shift was incredibly dramatic. You just had to watch X, right? It went from total euphoria to pure dread almost overnight. Hashtags like hashtag crypto crash were trending everywhere, driven mostly by that classic retail FUD, the fear, uncertainty, and doubt.
Oh, it was absolutely a cleansing of froth, no question. While the retail crowd was clearly panicking, analysts confirmed that the smarter money, the whales, the institutions, they were quietly accumulating. They were, as one report put it, scooping up discounted assets, essentially using that retail panic as exit liquidity for themselves, positioning for their long-term conviction bets. It's a ruthless pattern, unfortunately, but it kind of defines crypto volatility cycles.
Right. Which brings us to now, given all that chaos, what does the market actually look like right now? We're talking, 48 hours later, October 12th. The market's trying to stabilize. Definitely feels that way. But the metrics show it's, profoundly bruised. The total crypto market cap is around $3.76 trillion. Still a huge number, obviously. But the trading volume, that's the real story of exhaustion right now. It's down a massive 61%, down to $203 billion. That really suggests the panic selling is going to burn itself out. But we aren't seeing fresh capital conviction stepping in aggressively to buy this dip yet. It feels like a waiting game.
Yeah, that volume drop, especially coupled with the technical indicators, it paints a very clear picture. Immediate relief, maybe, but not necessarily recovery just yet. The relative strength index, the RSI, it's hovering severely oversold, around 33.36. For traders, that often signals that, technically speaking, a significant rebound could be brewing because the asset's just been dumped too hard too fast. But, we need confirmation. We need to see prices hold and maybe tick up over the next day or two to validate that signal. And let's look at some key prices right now. BTC is currently around $112,079, so it has clawed back from those scary sub-107K lows we saw. ETH is at $3,839. It actually showed relative resilience, didn't drop quite as dramatically, only from about $4.03K peaks. But what truly stands out, I think, is the divergence among the altcoins. We saw specific outperformers almost immediately.
Yeah, like BNB and XRP, those seem to pop up quickly.
Precisely. BNB was up something like 10.6% in 24 hours, trading around $12,249. That reflects some unexpected resilience within the Binance ecosystem specifically, probably due to internal market dynamics, maybe strong staking programs cushioning it. And then you have XRP at $2.41. It gained because it continues to benefit from those positive regulatory tailwinds, the ongoing legal clarity. That makes it a bit less correlated to the broader market fear cycle at times like this.
That divergence is fascinating, isn't it? You have retail traders basically melting down, but institutional money and the so-called smart money maintaining their conviction. The on-chain data, especially looking through Glassnode, gives us a pretty clear window into this dynamic. It confirms that long-term holders are actively accumulating BTC right now at these $110 to $112K levels. And even through the crash, the institutional inflows via the ETFs seem to be persisting. That tells you something, right? The systemic faith in the long-term crypto trend hasn't actually broken.
And that underlying resilience is already pushing the regulatory world into action, by the way. Exchanges like Binance, they're already announcing they are tightening perps rules post-crash. They're kind of acknowledging, implicitly at least, that the level of excessive leverage they offer was a systemic vulnerability, something that needs immediate addressing before regulators step in with potentially much heavier mandates.
Okay, so let's look forward then. This is the crucial part for you listening who wants to know. Was this just a nasty shakeout, or is it actually a setup for the next major leg up? And here's where it gets really interesting, based on the analysis we've seen. In the short term, let's say the next 1 to 4 weeks, expect volatility to persist. The sources are absolutely clear on this. BTC really needs to hold that psychological and technical $110K support level. If it breaks convincingly below that, it risks a full retest of $100K. And the advice coming from trading desks seems unanimous right now. Avoid the highly speculative tokens, memes, low-cap DeFi projects. They got absolutely brutalized, shedding 20%, even 50% of their value. The core takeaway seems to be, avoid perps trading entirely for now. The contagion risks in that highly volatile sector are just too high after an event like this.
And that regulatory ripple. It's likely going to be far more than just exchanges tightening perp rules internally. We could probably expect tighter know your customer KYC protocols across exchanges globally, but also a real technological focus on fixing the vulnerabilities exposed by that $88 million flash trade, specifically Oracle safeguards.
Right. Explain the Oracle issue again briefly, just for context. Why is that so critical?
Yeah, Oracles are key because they're the systems that feed external price data, usually from exchanges into decentralized finance systems, like lending platforms. When a flash crash hits, if that data feed lags, or if it temporarily shows a wildly inaccurate price because of a weird trade like that 88-meter one, well, the entire lending or liquidation system can break down, which is basically what happened here, amplifying the chaos. That's why the sources are starting to emphasize projects like, for instance, Iris. It aims to provide programmable, immutable data. The idea is real-time, tamper-proof fees to prevent these chaotic flash depegs in the future. We're seeing technology pivot immediately to try and solve the problem this crash really highlighted.
That's a great connection point. Okay, let's shift focus. Medium-term outlook. Q4 2025. If BTC manages to consolidate, finds its footing, and holds that crucial under $10 support, the outlook seems to brighten significantly.
Yeah, analysts are already sounding pretty confident that if we avoid breaking below 107K again, we could be on track for a powerful push, maybe towards 125K, even 150K by year end. This view is heavily fueled by the expectation that the persistent institutional ETF momentum will just reassert itself once the dust settles. 10x Research specifically calls this crash clearing the deck, basically getting rid of the weak hands, setting the stage for the altcoin market.
Ah, the famous alt season ignition. That's where the really explosive returns might be found if this recovery actually holds, right?
Exactly. Once BTC settles into its new, hopefully higher range, the expectation is we'll see a massive liquidity rotation. Money flowing out of Bitcoin dominance and into alts, targeting specific narratives. Remember, the total alt market cap, total too, it had already topped the 2021 all-time highs before this crash. That suggests huge underlying strength and potential. Insiders are apparently betting on a super alt rally starting maybe late October, focusing intensely on 3 specific sectors. First, AI projects. Their utility is growing like crazy, and their tokens are often fundamentally linked to computational power demand. Real value there. Second, RWA real-world assets. This is the tokenization of tangible stuff like real estate or bonds, bringing trillions of traditional asset value onto the blockchain. This is seen as maybe the most powerful institutional narrative for the next couple of years. And third, gaming. Still a massive onboarding ramp, bringing millions of new users into the Web3 ecosystem. Constant innovation there.
So we're not just talking about random hype here. We're talking about sectors with actual, demonstrable, growing utility. That makes sense. What are the specific targets people are looking at for the majors, like ETH?
Well, if that ignition scenario plays out, analysts are projecting maybe 2x, even 3x gains on majors like ETH. That could push it towards the $4.03K to maybe $7.05K's range by the end of the year. The confidence seems pretty high because, again, this crash likely eliminated the weak hands needed for the next sustained run-up.
Okay, zooming out even further, long term.
Yeah.
2026 and beyond, we seem to have the 2 classic paths emerging from the analysis.
Yeah.
The bullish base case and the bearish wildcard. What defines those?
The bullish base case is pretty straightforward. This crash was a necessary purge. It eliminated the overextension, shook out the leverage, and basically set up a much stronger foundation for 2026. Under this scenario, fueled by continuing ETF inflows, growing RWA adoption, maybe clearer regulation, BTC could target huge new highs. Some analysts are throwing out numbers like 150K to 190K. That's the trajectory of maturation playing out.
Okay, sounds good. But what's the risk? The wild card scenario.
The bearish wild card is basically that the geopolitical fears that caused this crash, specifically escalating trade wars, actually get worse. Maybe that gets combined with unexpected, aggressive Fed rate hikes if inflation stays sticky. That combination could absolutely trigger a more prolonged crypto winter. It could force a major retest of lower levels, maybe the $70K to $100K BTC range by mid-2026. And if that happens, the reports are pretty brutal. They predict maybe 97% of the smaller, less liquid altcoins could simply fade away, leaving only the tokens tied to really clear, demonstrable utility still standing. Survival of the fittest, basically.
The big picture, though, reading through everything, it still feels positive overall, doesn't it? Crypto isn't dying. It feels like it's maturing, maybe painfully at times. This volatility, while definitely scary, is maybe a signal that Web3 integration into mainstream finance is actually accelerating. And that volatility should ease gradually as adoption goes fully mainstream over the next few years.
Which brings us neatly to the most practical section. For you, the listener, maybe feeling a bit shaken up, how do you survive this sudden volatility and, importantly, position yourself to thrive in a potential recovery? We synthesized 4 key insider tips that kept coming up in the source materials. First, DCA through the noise. Dollar cost averaging. Simple but effective. Don't try to be a hero and time the absolute bottom perfectly. Just buy the dips incrementally consistently. The sources explicitly state that BTC consolidating around this $110K level is historically a steal for long-term HODlers looking back at previous cycles.
Okay, number 2 is about defense, right? Reducing your exposure to the immediate chaos.
Absolutely. Second tip, De-risk aggressively. That means getting rid of high-leverage perpetual futures positions immediately. They are just too dangerous right now. Pivot overwhelmingly to spot positions or even just stables if you need to preserve capital. Diversification is also key here. The sources recommend hedging, maybe adding traditional safe havens like gold or silver to your portfolio. They perform differently than highly volatile crypto, especially during a geopolitical crisis like the one that sparked this.
Makes sense. And the third tip, focus on the foundation, not the fantasy projects.
Exactly. Focus on fundamentals. You need to bet on specific, real utility, the kind of stuff the institutions are clearly targeting. Things like ETH upgrades enhancing scalability, Solana's continued performance push, XRP's role in remittances, the real-world use cases, not just short-term hype or fleeting meme season euphoria.
And finally, protecting yourself not just from the market, but from the bad actors who prey on this kind of confusion.
Right. Fourth tip. Secure everything. This is critical. Scams and phishing attempts always spike during periods of intense market fear and confusion. People are emotional, maybe desperate. Ensuring you are using hardware wallets, double-checking addresses, reviewing all your smart contract approvals, it is absolutely non-negotiable right now. Honestly, the threat of losing your assets to scams is arguably higher than the risk of further market depreciation during these wild swings. Protect your stack.
So wrapping this all up, what does this massive event really mean? The reports we looked at seem to frame this crash primarily as a necessary market correction, one that efficiently separated the long-term survivors from the short-term speculators. That staggering $320 billion total market cap wipeout. It's almost chillingly being called just October's blip in some circles, clearing the froth, basically, to make way for the next expansion phase. That's such a classic crypto mindset, isn't it? Watching $19 billion in leverage evaporate in minutes and thinking, okay, this is the start of the real fun. We'll leave you with the perspective of one ex-trader we saw quoted, which kind of sums it up. This feels like the start of the mania leg, not the end. This turbulence, as painful as it was, might actually be a signal of institutional maturation and market strengthening, not collapse.
And building on that, connecting back to the geopolitical trigger of those trade wars and the source's emphasis on things like stablecoins and better oracles, here's maybe a final thought for you to consider as you process all this. Given the persistent fear of trade wars, the potential for more tariffs, and the underlying wobbles we sometimes see in traditional fiat currency valuations, just how quickly might tokenized assets and tightly regulated stablecoins start to genuinely replace traditional safe havens, things like treasury bonds or even gold, especially if the world's most powerful nations continue using tariffs and economic policy as weapons against each other? Think about that deeper connection between the macro-political climate, fiat instability, and the ultimate long-term utility case for a truly decentralized digital currency system.